Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, February the 1st. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on with some economic data. Across the pond, we got a lot of PMI numbers, but it's not their flash PMI numbers, so I'm not going to continue to go over those. Those are, later than the flash PMI numbers, which is the most important numbers for the European region. I'll just say that they all did come in pretty much in line with expectations. Then here in the United States, we came up with the preliminary non-farm productivity quarter over quarter came in at negative 0.1%, expected to be a positive 0.8%, and they revised last month's number down from 3% to 2.7%. Now, these numbers are below what's expected. One would think that productivity being less would be worse for the economy. Well, what this really, it should say non-farm productivity cost index. And really what that has to do with is the amount of labor it costs to produce one unit of whatever the manufacturer is making. So if I can produce two of those now, my productivity in a sense has gone up, but the cost for producing each one of those units has gone down, and that's what this number reflects. So what that's saying is margins for companies are going up, and the worker has price has cost elasticity in a sense where they can demand more earnings because now rather than producing one unit, they can produce two units, which divides that labor cost up between those two units. Therefore, the margins go up. Therefore, I have room to make more money, which is good as soon as you get that will help inflation in a sense where the consumer is making more money and then therefore they can spend more money, I guess is what that comes down to, is what I'm trying to get at. All right, so preliminary unit labor cost came in at 2%, expected to be 0.9%. So that's what we're talking about with labor costs going up. If you can be more productive, causing margins to go up for the company, you have the ability to increase your pay in a sense. And we're seeing that happening, which is good. Unemployment claims came in at 230,000, expected to be 237,000, so lower than expected, good on that front. And then we got our ISM manufacturing PMI came in at 59.1, expected to be 58.7, so it's one of the highest readings we've seen in quite some time, almost all the way back to 2010, I think it was. And then construction spending came in at 0.7%, expected to be 0.4%, so construction spending up, that is good. And ISM manufacturing prices came in at 72.7, expected to be 68.3, so higher is good there as well, driving some inflation in a sense, since we've seen such low inflation. This is a good thing, actually. Natural gas storages came in at 99 billion cubic feet, expected to be 102 billion cubic feet, and we get total vehicle sales throughout the day. So on to the overall markets. We've got crude oil moving higher today by about 38 cents, as you can see here, and it is still inside of this trend channel. We came down there the last couple of days and have settled inside this trend area. I expected that to be what was happening, maybe even go down and test the lower band of the trend channel. That obviously hasn't happened yet, but yesterday we got a big move on higher than expected inventories of oil, a bit of a drawdown in gasoline, but gasoline's at the high end of the historical average, so there's a lot of gasoline in inventories there. Basically talking about moving from one bucket to another when we were talking about oil prices going up, and we're seeing a lot of that inventory come off. It was really just going into distillates and stuff like that. And I think that's going to still catch up with crude oil and expect it to kind of roll over a little bit. Today may be looking a little toppy. We'd like to see it settle inside this trend channel for that thesis to continue. Then on to gold futures, up on the day by about $2. Pretty quiet though in here. Everybody's kind of waiting and seeing what the overall equities do, I think, really to discern which direction we're going to go in. Bitcoin really having some trouble right now, and as you can see, the losses are accelerating in the last 45 minutes or so. Overnight basically kind of tumbled. We did get above that 10,000 area we were talking about yesterday, but overnight we've just really lost any type of traction to the upside and back well into that 10,000 area. Not looking good for Bitcoin and some of the other cryptocurrencies out there, like Ripple and things of that nature. All right, then on to the bonds. Bonds coming off. You know, I've been talking about them wanting to come down and test this 145 handle. Basically, have retraced all of yesterday's gains. That it was more of a, that's what a dead cat bounce looks like, as you get that little pop and boom, you get a slam down. We haven't seen the slam part of it, but I expect that to be happening relatively soon. We've got the VIX moving higher today. Actually, it's lower, but it's higher on the day from where we opened, I guess. Still up into the double digits, into that 13 handle. I'd like it to see it hold on to that 13 handle with bated breath and stay with volatility a little bit higher than what we've seen in the past in these single digits. It's getting a little ridiculous. All right, so the Dow Jones Industrial Average up about 64 points. Most of the trades that I did overnight, they're up on the day, like Facebook and things of that nature. It looks like Dow's going to lose General Electric. It's going to be like the first time since 1920 that General Electric has fallen off the Dow Jones. But we might be seeing that happening. So, you know, anytime these guys want to make their index look better, they take out the ones that aren't looking good and they put in the good ones. And what that does is it causes the index to go up. So is the index really the same as what it was against all these other ones? It's just they keep putting, especially the Dow, if you're not performing, they pull you out and they put somebody in that is performing. And that's what will help the Dow continue to trudge higher if they take out all the ones that aren't performing. But anyway, NASDAQ slightly off on the day. As you can see, we got a real mixed bag with the NASDAQ down, the Dow Jones up, and the E-mini S&P is pretty much unchanged. So everybody trying to discern where we're going to go with these equities. I mean, E-mini S&P is up a point, almost 2 points. But you can see we are off the lows. Opening of the morning, we just slammed down and then have since started kind of clawing our way back. I don't know if we're going to get there yet, but trying to make a move. All right, a couple of trades that I've taken off. Well, one trade that all these trades I've taken off now that I think about it. With XLP, if you remember on the 29th, I put on XLP, XLK, and XLU. Pretty bearish trades. I wanted to get some negative deltas in there, and they looked like they had overall fit the bill. So I went into the ETFs, had a lot of high implied volatility in these, and just looking for that implied volatility to come out, get my directional market assumption correct, which happened in XLP for me happily. So this was on the 29th, on Monday. So I did XLP, went into the March, sold the 60 calls in there for 42 cents. I bought them back today for 15 cents. So better than 50% of my max profit in there. A lot of that with a directional move yesterday and the volatility coming out, allowing me to get out in less than, basically 4 days, less than 4 days for the most part since I covered it early. So that was a nice little trade for those ETFs. The other couple of ETFs are a little bit away still. All right, PayPal. PayPal came out. Beat earnings. I mean, revenues were up like 23%, something like that. But at the same time, they announced that they were going to be parting ways with eBay. That really was the wet blanket thrown on PayPal's party. But this agreement doesn't come off until 2023, 2023, I believe it is. It's like 5 years away, and it's still a tentative thing. They just think they're going to try a different company. That's not written in stone yet, but they just released that 2023 they were going to be trying somebody else. So that was a downward spiral for PayPal. I still think PayPal is going to do pretty good. As a matter of fact, adversity with a company like this, I think that they are going to pivot a little bit and find some other companies that they can get that traction that they had with eBay. And as a matter of fact, I'm not sold on the fact that eBay is going to go with somebody untested rather than stay with somebody that has been very good to them in PayPal. Maybe they can work out an agreement where they charge a little less or something like that, maybe. But having said that, PayPal was a real pain in my pal. Yesterday, in my IRA and in my margin account, I put both of these trades on. In my margin account, I went in there with the PayPal trade and did the weeklies, did the February, sold the 80 puts in there for 49 cents. All right. In my IRA, I defined that risk, not to the risk that you would want to define it and make it like a regular spread where I didn't have to worry about it. This was really like a synthetic short that I put into my IRA to save on some margin in there. And what I did with that is go into PayPal and sold the 80 puts as well in the February weekly. Sold the 80 puts, bought the 76 puts, and I did it for a total of 45 cents. Now, I left on the long puts in my IRA, got out of those short puts. I basically sold the short puts for 67 cents, got out of those for $2.06. Now, I'm not happy about that one, but we can look at PayPal on the daily chart. I tried to put it in order. Usually when these trades go against me right away in the morning, I kind of let it breathe and wait for it to come back. What happened was this morning we slammed down, and on this slam, I tried to put in a dollar bid. I knew I was already in the money, so I changed the price. It was trying to default me to paying $2.30 for this trade. I put it in for $1. And I went in there and literally changed it, put 1.00, hit confirm and send in my IRA, and it somehow went and bought the 206s. So got out of my margin account, my IRA for 206. Didn't make that mistake in my IRA. I just let it ride, and it did go against me. As a matter of fact, at one point I was thinking, maybe I should have just done the fat finger in my IRA, or in my margin account, like in the IRA. But it did come back, as you can see here, and you can probably get it off a little bit better than what I did. I got out of my margin account that I sold for sold for 49 cents for $2.23. So I did a little bit better in my margin account because I didn't fat finger like I did in my IRA. All right, then on to the next trade. I did MasterCard, played it to the upside as well, sold some puts in there in the February weeklies. MasterCard, I did those February, and I sold the 162.5 puts in there for 80 cents, and I was able to buy those back for 10 cents this morning. That was on a nice big pop in there. They slightly missed on earnings, but forward guidance was really good, and I think everybody expecting with interest rates moving higher, the things like MasterCard, Visa, which comes out tonight, will do well. So I'm going to be playing Visa to the upside as well. All right, Facebook. Now this was a really funny thing. Last night on Facebook, I was a little bit shaken when they came out with their earnings. As you can see, as soon as they came out with their earnings, they just free fell. And a lot of this had to do with they are not getting the millennials signing on to Facebook. The millennials are doing Instagram, but Instagram is still Facebook in a sense. But they had a lot less growth in Facebook than they've seen in the past. So that was the catalyst for the big sell-off. And literally Jim Cramer from CNBC was like on a rant about people buying Facebook right about here. And that's when it completely turned around. Basically, Facebook has been knocking it out of the park with revenues and things of that nature. They're doing very well. And people kind of shrugged that off. You know what? The millennials, when they get a little bit older, will probably be on Facebook as well. And that's kind of what I'm looking at for that Millennials will slowly filter into Facebook. But Facebook just did that snap, but it was really funny that Jim Cramer was calling people a moron yesterday on the lows, saying you can buy as many as you want now. Well, it looks like people did. And Facebook got that rebound, which was nice. I did that MasterCard trade in my IRA. I don't know if I mentioned that. In MasterCard, I did the 162.5 puts and then bought the 149 puts in there in my IRA to define it. I only got out of the 162.5 calls for 10 cents. So a nice profit in my IRA as well. But here, let's talk about Facebook. Both in my IRA and in my margin account. In my IRA, I did the spread as well. And I went into the February, sold the 177.5 puts and then bought the 160 puts to define that risk for about a nickel. I collected $1.41 for that trade. Got out of my Facebook for 21 cents. In my margin account, in my IRA, only covering the 177.5 puts for 21 cents. In my margin account, I covered the same 177.5 puts for 19 cents. So I got into those Facebook for 144 in my margin account and got out for 19 cents. So got out a little bit better, but got in slightly worse on the actual puts themselves that I got in my IRA. It allowed me to get that one trade for a nickel. So anyway, got a little long today. Facebook, so later on today, that's the last one we got for that. But I did want to go over a couple of things that are coming out today. MasterCard we had last night. We're going to have Visa tonight. So Visa, I'm going to play to the upside, even though it's getting a little bit of pop today based on MasterCard. I'm also going to be looking at Google. These are all big ones today. So it's going to be a margin intensive. Sorry, I keep typing the wrong thing because I'm trying to talk and type. But Google comes out with earnings today after the close. I'm going to play this to the upside for sure. Amazon as well, because I think Amazon probably knocked it out of the park on the holiday season, even though it's been pretty parabolic going into that. Still going to play that to the upside because a lot of these other companies that are online retailers and or dealing with online retailers did very well, PayPal being one of those as well. So playing Amazon to the upside. There's also Amgen. I think I'm going to stay away from. I usually play Amgen's trades for earnings. I'm going to stay away from Amgen. Although they have had a pretty big move to the downside. I haven't looked at the chart on it today. And Apple I'm going to be playing. So Apple will be playing. Visa I'll be playing. Amazon I'll be playing. And Google I'll be playing. Probably staying away from the oil stocks. XOM. Chevron come out tomorrow. Sprint as well, but I'm going to stay away from Sprint too probably. All right, that's about it, you guys. Sorry, went a little bit long, almost 18 minutes. Check out Friday's webinar. We're going to be doing synthetic longs. How to do this trade instead of going out and buying a stock. We're going to use options, calls, and puts to synthetically create a long stock position. Check it out. It's going to be a lot less margin intensive. As a matter of fact, about 75% less margin. And if you have a small portfolio, this is the way to build out a portfolio as far as I'm concerned. All right. So if you can't take that, take it easy.